Hi, my name is Juanita Wright and I'm with eXp Realty. And today we're going to be talking about mortgages. So I have James as my co-host, and we're going to be asking a mortgage broker from Canada and a mortgage broker from the States about what's going on in the mortgage market right now.
Guys, from the last video, my name is James Clark from eXp Realty from the Durham area, serving the Greater Toronto region. And one of the reasons why Juanita and I wanted to host this meeting today is, again, to figure out what's going on in the market from the terms of mortgages. So we have two individuals here, one from Canada and one from the US. So gentlemen, welcome today.
Thanks for having me.
Thank you.
Okay, so Mel, you could tell us what part of the state you're from would be first, and just a little bit about yourself.
Sure. I'm in the Jacksonville, Florida market. So if you're up north and that white stuff is starting to fall, we can, we'll be happy to welcome you to the Sunshine State. I've been in the mortgage business a little over 20 years. That doesn't mean I have all the answers, but a lot of experiences, help me with, where to go to find the best information to help you make your decisions. And that's kind of the approach that I take with my clients. I'm not here to tell you what to do, but how things work, help you get good information to be able to make your decisions with. Thanks for having me today.
Okay, and Anthony?
Oh, hi. Okay, so I'm Anthony Valente. I live here in really Ontario. So I've been in the mortgage market 5 years now, and I'm with a company called the Mortgage Center, and we're based out of Woodbridge, Ontario. I too don't have all the answers myself too. We take individual mortgages on a case-by-case basis, depending on the client's needs. I focus more on refinancing properties, and I deal mostly with mostly with residential, some commercial property as well. And so every package is completely different. The client has certain needs, some requirements. So I sit down and I figure out the whole picture, and we just try it like a puzzle, put it together. And some are really, really challenging. Some are very, very simple, easy, straightforward. Of course, I like the challenging ones, that's basically it.
Okay. And James, what's the first question that you have?
Well, first off, one of the things we get asked is, how much can I borrow to buy a home? Now, Mel, I'm going to ask you, in the US, how much do I need to borrow to buy a home?
The program's kind of standard debt to income ratio is 41. Some programs go to 45. Others go to 55. So it's a total package, not just the new mortgage payment for the home that you're looking at, but also the addition of whatever debts you have that show on your credit report: student loans, vehicle payments, minimum payments on credit cards, and things like that. So, but in general, kind of a rough example of what that looks like: if somebody makes $4,000 a month and the program has a 50% debt to income ratio, then we've got, your bills, including the new mortgage, can't be more than $2,000 a month. So just as a very loose rule of thumb, that changes a little bit if you're purchasing an additional home. We work with folks from other areas that are coming to Florida. They own a home somewhere else and looking at, all right, do I qualify for another home here, a second home or an investment property, while keeping my current home? It may or may not have a mortgage on it. So two things there. If they don't have a mortgage, we still have to count whatever the expenses are associated with that property, the real estate taxes and the hazard insurance on the home, homeowners association fees, if there are any of those. So we look at that. That's an individual question. So unfortunately, no one easy answer for that.
If I can ask a question, based
Sure.
off of that situation, to put it simply for people watching this or not fully understanding the market, have you found that TDS and GDS has it gotten a little looser with this pandemic?
They don't have that in, you're going to be asking, because they don't have that in Florida.
Oh, total debt
We
service,
don't have that.
loan ratio.
No.
Okay. So
Well, we'll
We
call
call
it
it
total.
something different.
Yeah, well, debt to income ratio. But
Yeah.
yes, total housing ratio is one thing. That's the housing expense as a percentage of your gross income. And then total debt ratio, including all those other things we just mentioned, as a percentage of your income. So have they gotten more flexible of late? Not recently, but over the last few years, yes, things have loosened up a little bit. The non-QM requirements in the states have, they just extended the patch for that to keep ratios where they are. Instead of cutting things back to 45, we still have flexibility to some higher ratios. So yes, there is more flexible now than they were a few years ago, but not necessarily than just a few months ago.
And I think with Anthony, you have a whole different, because I think it's much more harder now. Am I correct in getting a mortgage?
Like again, it all depends on the individual. So we'll go through the quick 5 things that like I look at right away. For example, we're going to look at the person's income, right? If it's a married couple, for example, we're going to look at their total income. We're going to look at their loan to value of the property. We're going to look at their GDS and TDS. So I don't know the state, but I'll define GDS and TDS. So GDS is the gross debt service. So what percentage of the person's income is going to be applied to their credit cards, their lines of credit, and their mortgage? So there it's around the 35%. And all lenders are all different, right? And then gross debt service, then you have the total debt service. So that total debt service is what percentage of that individual's income is going to be applied to those same things, except we're going to also add the mortgage itself. So that can't be more than 42%. So our thing is getting harder. Again, there's always ways to kind of help out the individual. For example, if we need to make that person's income a little bit higher, well, we normally ask if they're let's say the property it can be rented, for example. So we can use up to 50% of rentable income to add on to that. So their income. So the income also is we're going to talk about their T1 general. Those are the forms that they need. This is what the government says that the person is making per year, right? So their T1 general is what's called then we'll also look at, let's say, pay stubs are looked at if in the event they're just working on a salary, right? Because a lot of people, as yourself, work on commissions. That's a little different. So income is broken down. And then, again, the loan to value. Now, we go out and we get an appraiser. The appraiser goes out and he appraises the property, right? So we can take up to 75% of that appraised value, and we can use that to answer the question, how much can I borrow, right? So we got the income, the credit score, loan to value, GDS, and TDS. So we package that all together and we come up with that number. And so depending on the couple that we're talking about, and let's say that their strength as far as income, but also the property that they want to buy or the one that they have, that kind of determines the package,
Okay.
So
Okay. So it's similar to the US then, it sounds like. They're about the same. Yeah. And so
those things are all very similar.
Yeah.
Right. Sounds like that. Now the interest rates, what's the interest rates in Florida from the interest rates in the States? I mean, in Canada right now, in Toronto.
Right. We're seeing rates in a range from the high 2s to the high 3s, depending on credit score, percentage of down payment, property type, ownership type. Is it a primary residence versus a rental, multi-unit? But just to give you a rough idea, high 2s to high 3s for the most part.
Now, Anthony, how is that looking in Canada, in the Toronto area?
Okay, so we've got as low, fortunately, we've got as low as 1.67%.
Wow.
We've got through. And again, those are requirements that we will have to make sure that they qualify. But that we can go that low, and that's on a 1 year, 3 year, 5 year term. We do 7 and 10 year terms as well, right? So we'll go from anywhere from low as to, let's say, 5.5%.
So with that, does that mean it's different with the, I heard that your time is different. Like you have to get your renewal done every 5 years or something like that, where in the States, if you have a 30-year term loan, it lasts for that time. You don't go back and find out if the person has the good credit and all that. Is that the same? Is that correct? Is that right, Mel? That's how it goes, right?
Yeah, I mean, most of the loans that we're writing are 30-year fixed. Seeing it at this point, if somebody's refinancing, we're seeing a lot of requests for 15 and 20-year to go shorter term because the rates are lower. But on purchases, and purchases are majority of my business, even in this market, 80 to 85% of what I'm doing is still purchase business. We have shorter term options as far as a 3-year, 5-year, 7, 10-year ARM. So what that means is that for the initial term of your loan, whether it's 3-year, 5, 7, 10, that rate and payment are fixed. After that, then it becomes an adjustable rate. So some people might say, well, why would you bother with, why would you do an ARM? Why have that uncertainty? Well, this property is a stepping stone. You know, I see some people are, well, I'm buying this house now, but I'm not going to be here long term. I may be here 5 or 6 years. Maybe a 7 or 10-year ARM makes more sense than a 30-year fix. Save a little bit on the rate and the payment in the short term, but it still gives you that fixed window of predictability and comfort that, all right, I can manage this because of the timeline. So they are different, but even when and I'm wondering if I'm hearing this right, we don't have any requalifying. Once you have the loan, you have the loan. You don't come back and reevaluate 5 years or 7 or however many years later. So once you have your loan, you have your loan. So if that answers the question. But
Anthony, I've got a quick question for you. We had something that was implemented called a stress test. Now, could you kind of walk us through and if that's still applicable today here in Toronto?
Yeah, it still holds. Stress test mostly with the people are out there buying homes for the first time, okay? And obviously what they were doing behind that is they wanted to make sure that people that were entering into mortgages only to find out that later they would be able to make their payments, right? So the government posed a stress test, which, you know, it's worked out very, very well. Not as well as, you know, some of them really want to purchase the home, but sometimes the decision needs to be made, and sometimes they should be passing just because it's a little bit beyond their means for that time period, right? So I think that's helped the economy, generally speaking, because lenders didn't want to get into that position where they're, you know, advancing loans and only to find out 3 and 6 months into the loans they're already defaulting, right? So that was the main purpose of this stress test. But if I could just, I wanted to ask a question on that answer that you were saying. Are those 20-25-year term, or are they 20-25-year amortization period that you were mentioning earlier?
both.
Oh, both. Okay.
So the amortization, you know, if it's a 30-year amortization, it's a 30-year term.
Oh, wow.
That is very
Now
different from Toronto.
like the 3-year and 5-year ARM are still a 30-year amortization.
Oh, wow. Okay. Yeah,
I think I'm probably
higher, right? No, that's interesting because it's a little bit different that way. We'll have like a 25, mostly 20-25-year term. We don't have 30-year amortization, but generally 1, 3, and 5-year terms, right?
So just to be clear, so does that mean that with your mortgages, you do have to go through a full credit check and everything after the 5 years and 10 year or whatever the term is? Is that how it works?
Yeah, whatever the term. Yeah. So, well, okay. Let's analyze what's happening. So the lender wants to know, okay, did this client in that 3-year period, did he tack on, let's say, maybe second and third mortgages on there? Was his Visa payment off, or his MasterCard off a little? Did he impose more lines of credit on there? So yes, the answer is yes. After that 3-year period, we do like a full evaluation again.
And so what happens if they don't qualify? What in the world happens?
So it's very simple. Maybe it didn't qualify with the local bank, but it'll qualify with a local trust company or a credit union or a private individual, depending on how bad this guy or couple went during those 3-year period, right? Like if they're making all their payments and everything is fine, the 5-year comes across, generally speaking, we'll move it on, we'll just extend it. But if in the event there's been things that have happened, transpired, you lost a job, one of the partners lost the job in the middle, they defaulted 3-4 times, maybe the Royal Bank won't we'll take them now to a B lender, like a trust company.
So that means your interest rate would be higher then, is that correct?
Yeah, it would, yeah.
Wow.
Now, I do see that sometimes in some scenarios for first-time home buyers working the opposite. If they're a new couple, maybe one person doesn't have a job, they may have to go with a B or C lender for that first term, but in that time frame, they've improved. So when their renewal comes up, they're able to actually switch over to a better quality lender with no penalties and then actually get a better rate depending on their terms.
Right.
Okay, so that's really good. Okay, so there's one difference right now that we see. Your mortgages are a little different.
I can only imagine. I know there's penalties when you leave a mortgage if you're breaking that term, be it 2, 3, or 4, even 10-year. Mel, I want to throw a question at you. What's a penalty if you're breaking that mortgage? Like if I want to sell a house and I still have, say, 25 years left, what does that look like?
There's no penalty. You sell it and the loan gets paid off. So if I have a $200,000 loan and my house is worth $220,000, I sell my house, my mortgage gets paid off. If there's any net proceeds left after the real estate commissions and closing costs are paid, then I walk away with a check. If not, I'm out and I don't have the debt any longer.
Okay. So Anthony, I'm going to throw that back at you very quickly. I know that's a very generic question based off of lender criteria. What would be the penalty in general if I was in a 3-year period on a 5-year term? Can you generalize that for us?
Yeah, so the lender all lenders are a little different, but usually they'll ask for between 1 and 3 month penalty. So if your monthly payments are $500, if you're breaking it in a 3-year period, they'll ask for a 3-month penalty. So that would be $1,500, for example, right? Sometimes we'll ask for an exception. We'll ask for, is that okay? We'll just ask for a 1-month penalty, and they might say, no, listen, we have here that, in the event that you were out of the, for whatever reason that was, for example, they came across some money, so now they want out. Well, they'll more than likely have to pay the 3-month penalty. In this case, $1,500.
Okay. Wow. Okay, very interesting.
A little different.
A little different. Okay, so the big question would be, I'm sure everybody's waiting for this. What are the programs that are out there that can help someone purchase a home? Mel first.
Well, I was going to say there's a bunch of them.
Okay, you just give me basic. 3.
Basics.
The best ones out of the 3.
In the States, we've got 2 categories of loans. We'll call them Govy and conventional. So you've got Fannie Mae and Freddie Mac conventional loans with as little as 3% down payment requirements. We've got government loans that two that don't require a down payment, one that requires a minimum of 3.5% down. And then you get to down payment assistance options for eligible first-time buyers. There are grant programs, there are bond programs to help people. So and again, to go back to kind of the beginning, one of the initial comments was that, it's an individual. Here's the thing, there's as many different mortgage programs and ways to structure things as there are flavors of coffee. There are a lot of options out there to explore. So it's a matter of, talk to a mortgage professional and get some guidance and some help as to what you qualify for, what you may be eligible for. So then you can evaluate those options and see what the best choice is going to be.
But I heard there's a rumor that, if you're a first-time home buyer, you get some money from the government. Is that true? You don't get any money from the government anymore? You used to get
it doesn't come from, it's not from the government.
Yeah,
There's a proposal for one. The Biden administration has a $15,000 tax incentive that they want to use to help first-time buyers, but that's a proposal. That's nothing, he's not even in office yet. So
Right.
there are some state programs, and that varies from state to state. There are also some local county programs to help people. Funding can vary. Sometimes there's money available, other times there isn't. Those programs go from like Freddie Mac's Home Possible grant from $1,000, or Borrower Smart grant that's $1,000 up to $15,000 in some county programs. So, but it's subject to, do you qualify and are you eligible? And if you check those two boxes, then the third one is there funding available currently? Because those programs are funded with tax dollars for the most part. And so they've got to renew, local governments have to renew funding for those programs. In the state of Florida, there's a bond program that shouldn't ever run out of money the way it's structured.
But it always does.
There is a fixed amount of money there. It's not unlimited, but they've not run into funding issues the way the program is structured. So that $7,500 bond is always there for folks. And the difference between the grant and the bond is the bond does get repaid at some point. You sell or refinance. The grant program is that it's a grant. You stay there for the required period of time. Typically it's 5 years, then that money's forgiven and you don't owe it back.
That's nice. Now I'm going to direct this question to you. What do you feel now? Just imagine a first-time home buyer's watching.
Right.
What is the very first thing that home buyers, when they're getting ready to do, should have ready before doing anything, before even calling us the realtor?
Have a conversation with a lender. And I know that sounds really simple, but just to have the conversation around, a lot of first-time buyers I found are hesitant. Oh, they think if I talk to a lender, they have to pull my credit. No, we don't have to. Not to talk about, well, what do you want? Do you monitor your credit? Do you look at it? Do you know what's there? Do you have any issues in your credit that we can help you with? We can talk about what your credit needs to look like to be able to qualify. No, you don't need perfect credit. You want the best terms, better credit certainly helps. We can talk about income. We can talk about assets. Where is the money for closing going to come from? Can we document it properly? We can do rough estimates to give you an idea. All right, I've got $8,000 saved. Is that enough to buy a house? Well, for some people it might, depending on your price range and the program you're eligible for and that sort of thing. Have that conversation first and early. Some people wait for their lease to be almost up before they reach out and say, all right, what do I qualify for? I got to move by the end of January. All right, you got 10 weeks to find a property, get under contract and close. You got 2 holidays in the way, and maybe you get there, maybe you don't. Have the conversation early, and if that conversation goes well, that your ducks are lined up. You're going to sleep great between now and whenever that time is. We identify that, hey, if you want to move in March, have the conversation now, get that process started in the middle of January. Here are the documents you need. We can walk you through, send you a checklist of, here are some things you need to pull together to be ready to take that step. We can talk about how long a credit report's good for. For the most part, it's 120 days. More people today are conscious than ever about having their credit pulled, what that means. How many points do I lose? How long is the credit report good for? If I get pre-qualified, do I have to get re-qualified again? Do you have that conversation with a lender now to game plan? If you've bought a home before, things have changed. Likely they've changed. If you bought more than 3 or 4 years ago, the process is different today than it was then. Most of the difference is around the documentation that's required. There's more documentation required now than there's ever been. If you bought a house 20 years ago, wake up call. It's very different, but that's what your mortgage professional is there for. We're here to help you with, here's what you need. Hopefully they'll explain why we need it. Having a reason behind the rhyme, I think, is really important. And to help you do that advanced planning so that you can play the cards the way you want to play them, where if you wait too long, you might still be able to get there, but your options may be limited. You may not be able to improve your terms. If somebody comes to me today and says, hey, I have a 638 credit score, can I qualify for a mortgage? Well, yes. But in qualifying, we may find that, hey, if you pay these 2 credit card balances down over the next 4 to 6 weeks, your score is going to come up over 680. Now your interest rate is this, or the points that you might pay for that rate are now down to this. There's a difference. The other thing is, I'm not here to judge anybody. A lot of people have had problems. I've talked to people that are afraid, scared. I don't know. I'm afraid of what you're going to tell me. What we're going to tell you is what you need to do next. We're not here to say yes or no, you're good or bad. I've seen people play all their cards right and have their financial picture just crushed by a cancer diagnosis. Did everything right, paid their bills, worked hard, did everything the way they were supposed to, and have something crush their financial picture. We're not here to judge. Where are you today? Where do you want to be? Let us help you get there. And
Mel, very quickly, I just want to ask
Sure.
that last thing. So after all that, do you charge for this information to get this
No.
information to set up for people?
No. No, we don't. I know some companies will charge an application fee. I'm not saying that's good or bad. If you're going to pay an application fee, make sure you get your money's worth.
Absolutely.
That's all.
So Anthony, I have a question for you. For any first-time business purchasers, I'm going to say, we own our home, we're getting ready to use some money. On the business side of things, what is your advice to someone that's wanting to start to take that venture with a professional or business or commercial mortgage?
With the commercial, so they basically, again, I agree. You basically were looking at the whole picture. They have their house, maybe it's 50% loan to value. Now they're looking out to is it to purchase a business or like the land and building, or the business only, or
I guess as an investment, what would be the first thing when someone's wanting to start that investment journey that they should do?
Yeah. So basically, again, it boils down to going through the application thoroughly, and so that we can see what they qualify for. Now, again, we'll now look at a potential lender in this particular case that varies. They all vary, and getting them pre-approved. Also, again, we have like a separate form that we go through that where the GDS and TDS may change a little bit, they may vary. But that's basically it. Like, I kind of simplify it and basically go through just several questions in that application form that we'll see if if they qualify or not.
Now, as well, the same question I asked Mel, do you charge for this consultation for someone wanting this information?
No, there is no fee for that. I'm sure it depends on companies, different agents, but I don't definitely charge for that.
So to summarize, it sounds like there's some pretty good offers right now on the market, both on the professional side and the residential side. I can tell you first off, guys, one of the things that blew me away was a 30-year term in the US. That to me was news. I didn't know that, so that's cool. But I think really importantly for the people watching, if they want to start this home ownership or business and commercial ownership, it's free. And the first thing they should do is talk to a lender and talk to you guys.
Yeah,
Absolutely.
And the funny reason why I decided to get both of you guys, one of the things is because I've actually worked with Mel, and I found him, he's been on a lot of radio shows and stuff with me, and with Anthony, because I talked to him and he was so knowledgeable. I said, I need you guys together. Studying for both real estate license in Florida and in Canada, I realized you guys are different. There's a lot of different things. So I said, let me put them together and let's bounce off some information to see what really is different. So we did have a lot of things that were similar, I found also. So it's quite exciting that, the road to getting ownership is almost similar too. So that was exciting to hear also.
Yeah.
So,
that's awesome.
Yeah, so just wanted to thank you guys for all. Do you guys have any questions to each other about, real?
Actually, I do have one question. I know I'm reading more and more about offset mortgages. They're very popular in Western Europe and in Australia and New Zealand. Anthony, do they have offset mortgage options in Canada?
Not that I'm aware of.
Okay.
I've actually even heard of offset mortgages. How do they work in the States?
The offset mortgage is a combination of, I just found I was trying to find a definition for it that kind of makes things easier. I've tried to explain it and I found one. The offset mortgage it's a type of mortgage where the savings account of the borrower is linked with its mortgage, offsetting the balance between the accounts and the balance owed on the mortgage. So if you have a house that's got a $300,000 value, you have a $200,000 mortgage, and your income is higher than your bills every month, the money that goes into the account offsets the balance of the mortgage. So I may start out this month with a $200,000 balance. My wife and I have $10,000 in income go in. My balance just went to 190, and the interest is charged on the nightly close of the account. So for a week, I may not pay a bill for a week. My balance may sit at 190. So I'm only paying the interest on 190. Next week, I have, my minimum payment for my mortgage draw comes out. I pay my car payment, my tax, my cell phone and hazard insurance, and my son's tuition for school. And, at the end of the month, my balance may be 98,000. So for the month, I paid interest. I started at 200,000, but I paid interest on balances that range from 190 to 198, saving me money. Next month, that process kind of repeats itself. And my nest egg, my savings, becomes the equity in the property. So I have access to that at any time I need it. If there's a death in the family and I got to buy 5 plane tickets tonight, I can do that. I've got the money. I can do my thing, and then that money gets paid back the same way. So they're very popular in Western Europe and Australia, New Zealand. We have a program here, and I'm learning. I'd never heard of it before until I came to CMG 2 years ago, and got introduced to a couple of my peers who use this program quite a bit. I'm starting to see there's an option, and I was wondering, in Canada, is this a program like this? Is that an option? I wasn't sure.
Okay. Similarly, how about in the States when it comes to prepayment privileges, when it's like a residential or commercial property? Do they have something like they're allowed up to 10% of the principal amount to be paid back without penalty? Can they do stuff like that?
Right. Most residential mortgages written recently, I'll say in the last, let's just say 10 years, no prepayment penalties. Used to be a lot in the early 2000s, late 90s, early 2000s. If you took an adjustable rate mortgage after that period, if you paid it off too soon, there was a prepayment penalty to be had. Most residential mortgages now, because of the predatory lending issues that were discovered, learned, came to the forefront, however you want to word that, came out of 2008. Prepayment penalties have gone the way of the dinosaur for the most part. On the commercial lending side, I'm not as familiar. I'm not sure. I'd have to defer to one of my counterparts on that. I'm going to say there may be more. That may be more common in the commercial side if you pay off too early, but not in residential mortgages anymore.
Oh, that's awesome. Thank you for that.
Thank you. Okay, so and do you have any questions to ask Mel, Anthony? Or you're good? Got all your questions?
Good. I was curious about that prepayment because that's something here in Canada that we have, right? And but funny thing is they ask for this, but they never take advantage of that. Normally they'll do it during the term. So
right.
I'm curious. Yeah, they had that.
Okay.
But no, I'm good.
Okay, excellent. Thank you guys so much, Mel and Anthony and James, for coming on the Zoom call and just giving people information about mortgages.
Okay.
And thank you guys so much for taking out time to do that.